Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Valvoline Inc. quarterly report. Valvoline Inc. is a leading provider of automotive preventive maintenance services. With a rich history dating back to 1866, the company has established itself as a trusted name in the industry. Its extensive range of services includes oil changes, which are essential for maintaining the health and longevity of vehicles. In addition to oil changes, Valvoline offers various other maintenance services such as battery replacements, bulb replacements, and wiper replacements. The company also provides tire rotations, which help extend the life of tires and improve vehicle safety. These services are available at its retail stores in the United States and Canada, making it a convenient option for car owners. Furthermore, Valvoline operates in franchises service centers and retail locations across North America. This widespread presence enables the company to cater to a large customer base and provide them with quick and reliable access to its services. With its commitment to quality and customer satisfaction, Valvoline has solidified its position as a leading player in the automotive maintenance industry. The list of businesses and services provided by Valvoline Inc. includes oil changes, battery replacements, bulb replacements, wiper replacements, tire rotations, service centers, retail locations. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to drop. The stock price of any publicly traded company can fluctuate due to various market and economic factors. One possible reason for a decline in stock price is poor financial performance, such as declining revenue or profits. This can be caused by a range of issues, including increased competition, changes in consumer demand, or internal operational problems. Another factor that can contribute to a drop in stock price is negative news or events surrounding the company. This could include announcements of layoffs, product recalls, or regulatory issues. Additionally, external market factors such as economic downturns, interest rate changes, or shifts in investor sentiment can also impact a company's stock price. In some cases, a decline in stock price may be due to industry-wide trends or sector-specific challenges. For example, if the entire automotive industry is experiencing a downturn, companies like Valvoline Inc. that operate within this space may see their stock prices drop as well. It's worth noting that short-term fluctuations in stock price are common and do not necessarily indicate long-term performance issues. Investors should consider multiple factors when evaluating a company's prospects and make informed decisions based on thorough research and analysis. Valvoline Inc. maintains a market capitalization of $5 billion, broadly in line with the industry peer group. Valvoline Inc. trades at a higher price-to-earnings ratio of 53 times and a higher price-to-book ratio of 15.3 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company exhibits a very high leverage profile, with liabilities accounting for 87% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has aggressively reduced its share count by more than 5% while revenue has grown, but assets and equity have declined. This suggests management may be prioritizing buybacks over reinvestment, raising questions about long-term growth prospects. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a review of key financial and operational metrics. On the positive side, net revenues increased by $47.5 million in 2025 compared to 2024, driven by several factors. The acquisition of Breeze contributed significantly, adding $15.7 million to revenue growth. Additionally, network expansion, including the opening of 335 new stores, and system-wide same-store sales growth of 5.8% also played a crucial role. Furthermore, favorable improvements in service mix and pricing helped boost revenues. On the other hand, there are no explicit mentions of revenue decline drivers. However, some factors that may have contributed to revenue decline include discontinued operations from the sale of Global Products business and required sales of 45 stores following the Breeze acquisition, resulting in a $57.9 million loss. The net income of the company underwent a significant change between 2024 and 2026. Initially, it decreased from $91.6 million to a loss of $32.8 million in 2025. However, this trend was reversed in 2025 when the net income increased to $46.9 million. Unfortunately, the company's financial performance took a hit again in Q1 2026 with an implied loss due to a pre-tax loss on sale of acquired Breeze stores. The profit margins also experienced fluctuations during this period. The gross profit margin remained relatively stable, decreasing from 36.9% in 2024 to 37.3% in 2025. On the other hand, the operating income margin took a significant hit, dropping from 30.7% in 2024 to -1.3% in 2025. Despite this decline, the company's adjusted EBITDA showed an improvement of 14% over the prior year period. The company's financial performance is a testament to its ability to generate positive operating cash flow. According to the extracted summary, the company has consistently demonstrated this trend over the past 2 years. Page 3 explicitly states that the company has achieved positive operating cash flow, with specific amounts provided for December 31 and September 30, 2025. This is further confirmed by page 4, which reveals that both 2025 and 2024 had positive operating cash flows of $64.8 million and $41.2 million respectively. The increase in operating activities and cash flows provided by operating activities for 2025 compared to 2024, as mentioned on pages 27 and 28, also indicates a positive trend. This suggests that the company's financial management is effective in generating sufficient cash flow from its operations. Overall, these findings confirm that the company is indeed generating positive operating cash flow. The company's debt level has experienced significant growth over the past year. According to the extracted summaries, long-term debt increased from $1,050.2 million in September 2025 to $1,633.6 million in December 2025, representing a substantial rise of nearly 55%. Furthermore, total debt has also seen an increase of $590.8 million, rising from $1,074 million to $1,664.8 million. In terms of interest expenses, while not directly stated on most pages, there are some implied changes. Net interest and other financing expenses increased by $8 million, indicating a rise in the company's financial obligations. Additionally, with 32% of borrowings having fixed interest rates, it is likely that the company will continue to incur significant interest expenses as its debt level continues to grow. Overall, these changes suggest that the company's debt level and interest expenses have increased significantly over the past year, posing potential risks to the company's financial stability. Management is optimistic about the company's outlook and strategy for growth. The key focus areas include expanding the store network through strategic acquisitions and dispositions of underperforming stores. This approach is expected to drive revenue growth and improve profitability, ultimately providing significant long-term value to shareholders. The company continues to invest in its business, prioritizing long-term growth and scaling operations. Recent results demonstrate this commitment, with adjusted EBITDA from continuing operations increasing by $14.6 million over the past quarter. This growth is attributed to strong operational performance, which has led to gross profit expansion. Overall, management's strategy appears to be yielding positive results, positioning the company for continued success and value creation. That concludes the financial summary for Valvoline Inc. Feel free to comment below, and I will be happy to answer them when possible.